Today's speakers are Scott Callon, our Chairman and CEO, and Akihito Okochi, our Chief Financial Officer. Now, Scott Callon will start the presentation with an overview of the ended fiscal year. Scott-san, please.
We're grateful for it. We'll do this presentation in three parts. I'll start by going through an overview of FY21-3, so the March 21 fiscal year. Then Okochi-san will go through the numbers, and I'll come back and talk through our strategy. So, I mean, in a word, it was a very hard year. I'm sure it was hard for everybody on this call. It was hard for the world. It was hard for Japan. It was hard for JDI because of COVID. So that was, we spent the year working really, really hard to keep everything up and shipping, and we did that. I think that it was a critical success, and we had to manage the supply chain through this, which was also a very difficult task. But it happened. We did progress our technology R&D roadmap, and we began mass production of 76 new products during the year, which is up 9% versus the previous year, which was just an extraordinary effort by everybody involved, the R&D teams, the engineers doing the design, and those in the factories. We have to cut our fixed and variable costs, so we did. We generated positive gross profit, and we significantly reduced our operating loss. That's not nearly enough. There's a lot more to be done, and we are doing it. We reinforced our capital with the large-scale equity financing from Ichigo Trust, and we significantly strengthened our governance and established systems to prevent recurrence of inappropriate accounting. For those of you who are not familiar, we did something really wrong. It should never have happened. We had inappropriate financials in previous years, and we fixed all of it. So let me go quickly through the business. We don't have endless amount of time in this call, so I'll just step through some of the highlights. In the mobile space, we made a mistake. We thought that several years ago, we thought that smartphone demand was going to remain with high-end LCDs, and in fact, what happened was there was a shift to OLED, and so we lost a significant amount of orders from a major customer. In response to that, we need to cut our costs in a big way, and we have. Including the sale of a Hoxon plant. So that's a plant in northeastern Japan in a city called Hoxon that was designed to do very high-end LCDs that we no longer needed. And the good news is very strong sales of smartphone LCDs into the Chinese market is something I'll touch on later, but it is clearly the case that substantial demand is coming at us in a positive way. On automotive, that was the most impacted sector for us by COVID, with the sales going through the floor in Q1, and then a very strong rebound from Q2. And by the end of the year, we're seeing year-on-year increases in our automotive space relative to the previous year. Non-mobile, the key events there are we're going to see very strong demand on shipping of our OLED product for wearables. And I'll talk about this a little bit later, but LCDs for ultra high resolution VR devices, where we have a clear technical and production and yield advantage relative to our competitors. In R&D, again, a good year for us in terms of moving forward on the technology roadmap. We have a lot of things that we want to surprise the world with that are exciting. Our biggest challenge in R&D historically is that we haven't been fast enough in getting the product to market, or haven't been thoughtful about which places we want to place our technology bets in order to generate the highest earnings. And so that's a change that we've made. The final point, we know on a company-wide basis that there has been a COVID impact that we continue to deal with. There are trade conflicts which seem to have lessened somewhat. The tightening of global semiconductor supply and demand is a daily battle. You should know that. The shortage in driver ICs, so in our case, display drivers, is a critical negative. We have incorporated significant downside from the shortage in this year's forecast. We're hopeful that, and there's every sign that the situation is improving on the margin, but it's still a daily battle. And I'm personally involved as CEO and talking with suppliers and customers and trying to sort out how we allocate product, the chips in the best way in order to serve our customers. Absolutely critical for us to increase our cost competitiveness in this year. So again, I'm talking about the year until March 2021. We reduced our fixed costs by 27 billion yen, so roughly US 270 million. That's huge. I mean, the plan is to take down our break-even point very substantially. And so when we drive higher volumes, and we expect this year will be the bottom, so fiscal year March 2022, so the year that we're currently in, that this will be the bottom for us from a revenue perspective. We're pretty confident. We're very confident we already hit the bottom from an earnings perspective in the year that we're talking about today, FY21 and 3. So we've double bottom, and we're coming up from here. And you drive down your costs, you drive down your break-even point, and so when you rebound, you make money. And the goal is to make a lot of money for our shareholders. So we took down our fixed costs by about 27 billion yen. We took down our variable costs by over 10 billion yen. Those are very, very important deliverables for the firm. In terms of business activity, the three keys were strengthening our governance, rebuilding our financial base, and building new businesses. I'm not going to talk endlessly. We have Q&A today, so I'll take Q&As on things that you care about. Very specifically, though, as I said earlier, we had a problem, a governance problem that we fixed. Completely revamped the board, revamped our control structures, went through a process, very detailed with the regulator, both the FSA and the TSC, Tokyo Stock Exchange, taking the lead on it. We went through this process of all the things that we diagnosed that we had done wrong, how we're going to fix them, and we've completed all of that. We sold, as I mentioned earlier, the Hoxton plant. We built it to do high-end LCD. When the market shifted away to OLED, we no longer needed it. The two key deliverables from that, from a financial perspective, are it takes down our costs by 8 billion yen per annum, and also on the bottom of the page you can see we took a gain on sale on it of about 19 billion yen. So 100 yen to the dollar, that's about $190 million US. We also did a financing with Ichigo. It's been partially exercised, so 19 billion yen has come in. There's another 36 billion yen to come, which we fully expect that we will get this year. So that's what I have in terms of the past year. Okochi-san will now go through the financials, and I'll return and talk about the forward strategy.
Hi, I'm CFO Akihito Coach, and I'll cover our financials. This is the financial results summary, and as you can see here, the net sales was 341 billion Japanese yen, and net loss 42.7, and EBITDA 12.5 negative numbers. As I explained at the third quarter financial announcement on February 10th, the major customers shifted their smartphone display from LCD to OLED, and consolidated sales dropped to this number. This is almost equal to the forecast, 342.5 billion at the previous financial announcement. On the left bottom side, as you can see here, this is the sales by product categories. You can mobile, Europe and America. Sales was 160.2 billion yen. The majority was for our main smartphone customer, and the sale became a half amount of the previous year. On the other hand, non-mobile increased, and automobile has been back to normal. Non-mobile, especially wearable OLED, which started mass production in last year for the main customer, and ultra high resolution LCD for VR, the sales increased 6.6 billion Japanese yen, 13% to 56.2 billion from previous year. automobile sales was bottom at the first quarter and has been back to normal since second quarter. And as for fourth quarter, was bigger than the previous year. I expect the sales will be stably, gradually growing going forward, and I'll explain the details in the part of first fiscal year 21 forecast. As for P&L, although sales significantly dropped, we made every effort to cut fixed costs by Hexen plant sale, management reform in 2019, and any other cost reduction. And then gross profit became positive. Operating income improved by 12.2 billion. EBITDA improved 7 billion, respectively. I'll explain the details by the next slide. As Scott explained earlier, we achieved a fixed cost 28 billion and reduction and variable cost 3 point improved, respectively, as announced at the second quarter financial announcement. As a result, operating income improved 3.3 billion comparing to previous forecast, 29.6 billion yen. However, as you recognize, well, we do need more measures in order to make JDI profitable. So we subsequently take measures and move forward them. Well, we will achieve the EBITDA positive at the fourth quarter, as we announced before. Next slide, you can see the change factors of operating income from 19 to 20. As I explained earlier, due to significant sales drop from 504 billion to 341.7 billion, shipment volume and product mix decrease caused 29.8 billion loss, and we strongly implemented cost reduction as I explained earlier. Hexen plant sale, significant fixed costs cut by management reform and any other costs written here, and made 27.5 billion in total. Additionally, there are no specific significant factors as the previous year. As a result, operating income improved and it became 26.2 billion loss. And next slide. This is the changing factors by quarter base. On the left side, you see the comparison of fourth quarter of 2019 and 20 year-over-year base. On YOY base, due to sales drop, shipment volume and product mix decline 4.7 billion, but cost reduction, as explained in the previous page, made 2.7 billion improvement. And then final operating income became 7.6 billion loss. On the right hand side, the comparison third quarter and fourth quarter, and 10 billion increase, 1 billion increase by shipment volume and product mix, mainly worked operation income improvement. I will talk about the balance sheet here and cash flow statement in the next slide. Firstly, balance sheets. Fixed asset was decreased by Hexen plant as explained, and total assets was significantly downsized from 389.7 billion to 225 billion, 42% decrease. Related to Hexen plant sale, advance received debt as a relevant debt was fully repaid. Although net loss was 41.7 billion, additional equity injection by Ichigo, net asset was 41.8 billion, and shareholders' equity ratios increased 4.5 point to 70.6%. There's still 36 billion unexercised portion of stock acquisition right by Ichigo, we plan to implement capital enhancement by such exercise in this year. Cash flow, consolidated cash flow. As for operating cash flow, net loss before tax was 41.7 billion, and working capital was 20.6 billion positive because of the shrinking of LCD smartphone business to our main customer. With this, with other factors, operating cash flow was 23.1 billion negative. As for cash flow investing activities, we controlled over capex and decreased the 9.1 billion yen. Cash flow, financing cash flow. Equity finance from Ichigo, 5.5 billion for preferred stock and 19.4 exercise stock acquisition right. And in total, 20.2 cash flow statement. Net free cash flow was improved to 13.2 billion negative, and cash balance was 55.3. Finally, this is the this is forecast. From this time, we've decided to disclose the sales breakdown for both full year and quarter. Full year forecast is 254 billion, and as explained at the financial announcement on February 10th, the main customer shifted from LCD to OLED, and then mobile, Europe and America will continuously decrease, but the automobile and non-mobile business will be continuously well. Automobile, as I explained, we got up the COVID-19 effect, and we see a big demands globally, not only United States, Europe, China, and Japan. But on the other hand, we continuously closely pay attention to the potential effect by semiconductor components shortage. Even we conservatively assume such effect, we expect 103 billion sales, 70% more than the previous year. And non-mobile, we expect a 70 billion, 25% increase due to the good sales of both wearable OLED to main customer and ultra high resolution LCD for VR. Mobile, expect Europe and America, we see a continuously high demand in China market. However, we considering business profitability, we do not plan to rapidly grow this business and expect the same level as the previous year. Despite of sales business model, its profitability is improving right now. As for P&L, we still expect 8.8 billion operating loss because of sales decline. However, as announced earlier, we target this fourth quarter EBITDA profitable positive, and we expect OLED wearable sales increase and the cost reduction and other measures. Finally, the sales was bottom for this year, and P&L operating income was bottom at the previous year, and we aim to achieve the EBITDA positive for this year. In order to do so, we are still looking into the strategies, and will CEO Scott will explain the strategy later on. Thank you.
let me go through the strategy. 3 central points. First is game change, meaning we've been unprofitable for a number of years. JDI has absolutely world-class technology, engineering, customer trust, customer commitment, employee commitment, and had the wrong cost structure, and very specifically made the wrong bet on the future of smartphone technology, and that put a $2 billion hole in the balance sheet coming from the Hoxton plant. So we need to do a major reset of who we are, and we are. So nothing small is going to happen. This is a world-class company with world-class capabilities, and we're going to execute a game change in order to get those capabilities out into the world. The second one is JDI is different, meaning we need to be different. Completely uninterested in having a Me Too strategy. The firm has a distinctive set of capabilities that are world-class. We're going to deploy those capabilities in a way that is unique and differentiated. And our view on that is that if you want to serve customers in the world, you need to be different. I mean, if you're doing the same thing as 3 other firms, what exactly is your contribution? So a very strong focus on going big in game change, a very strong focus on being truly differentiated as a second pillar of the strategy. And the third is we're a personal tech company. We build products that are used in people's daily lives. There's no question that displays are a foundational technology for modern life. Those displays are used in smartphones, they're used in wearables, they're used in VR devices, they're used in notebooks, they're used in cars. That is our key deliverable to the world, is products that serve people's daily lives. In terms of the specific strategy, it's implementation. It's 2 focuses. One is strengthening existing businesses, and the second one is building new businesses. And the KPIs are very important. So we're guiding to 8.8 billion yen loss in Q1, and I'll go through why we think this KPI is achievable, and we do. But we're targeting turning EBITDA positive, so cash positive, cash earnings positive in the 4th quarter of this year. Absolutely critical deliverable. And that's just the first step, right? We want to be robustly profitable as a firm, and we think we can get there. And the second KPI is we're going to build new businesses, and very specifically, we expect to launch multiple service solution and platform businesses this year. So not fiscal year, but calendar year, by December, leveraging our key device technologies. In terms of what we want to do, what are the kinds of businesses that we're willing to be involved in, what kinds are not? I mean, this is kind of the threshold criteria we're using on: do we stay in a business, do we expand a business, do we enter a business? One colloquially, 3 bigs, meaning there needs to be a big need, there needs to be a big market, and we need to have big impact. We're not interested in, this is about a game change. We're not interested in doing things that are small, that don't move the needle, that don't change the world. And so the third point, big impact, is important also. There's a big need. Because there's a big need, there's a big market, and JDI's participation, we can't really have much of an impact. We're not interested in that. We really want to have an impact as a firm, and we think we can. And the second one is JDI needs to be different. So again, there needs to be a unique set of capabilities and deliverable to customers. Otherwise, why were we even involved? And needless to say, it needs to be highly profitable. So those are, I mean, and these are hard screens. The Venn diagram, the joint set of all these things together is not a big one. And that's the point. We're going to be focused on where we can really deliver value for customers in the world. One of the things that went wrong is we lost a bunch of orders from a huge customer in U.S. and in mobile in U.S. and Europe, and that they were, we would prefer to have that business and not have it. But the reality is, we had a business that was very focused on a single major customer, and the risk of that is you lose a customer. And so we've gone through the risk. The bad thing has happened. And the lesson that was learned is you need to have more robust, more diverse, less concentrated product segments, so that you don't have a problem where you fall over when you lose a major customer. And so that's where we are today. So at peak, the major customer was about 60% of our business in mobile. It's down to 19% and it's on mobile in US and Europe. What's grown is non-mobile. and automotive. And those have much more diverse customer sets, so we don't have critical customer risk anymore like we did. And also very explicitly, and this is part of the strategy, one of the reasons why automotive is a very good business is because you get, you're shipping, against cars that have a model life, of 5 years, of 10 years, and you also have after service around that. So typically, the order stream for automotives is going to be 5 to 10 years. So it's a very stable business. So what I'm getting at is there's a strategic priority of the firm, and one what we're delivering against is to have substantially more diverse and more stable earnings. And we will continue to focus on that and deliver against that. Let me talk a little bit about the market environment. So if we're forecasting a loss, we think, of 8.8 billion yen. 2.3 billion yen of that is linked to the semiconductor shortage. So that's presumably at some point the world gets through this. So that's presumably one off. But why do we think it's credible? And we do think it's credible that we get to EBITDA break even by the fourth quarter. And it's really linked to the upside earnings opportunities. So one of the things, and we've let the market know this already, we have done are doing a major expansion of our OLED production capacity. That will be done and it's a back-end expansion, meaning the front end, which is where the heavy CapEx has to occur, has already happened. So this is actually being entirely done by AMS back-end partner. And that production capability expansion that happens on the back end means that we can do substantially greater sales of OLED. And we fully expect we're going to get the customer business and are talking with a key customer for that purpose. So we think that's a big driver, and that appears in Q3 and Q4. The second one is improvements in pricing and product mix. A big bunch of this, quite honestly, is difficult conversations with customers on, we are a major supplier to you in many cases, particularly in auto space. Over half the time, we're the single source supplier. And the reason we're a single source is because we have this extraordinary track record of technology and quality and reliability and these super trustworthy engineers. And it speaks to the degree of trust for Japan and Japanese companies across the world. When we make a commitment, we keep our promises. And so our customers, which are primarily global customers, want to do business with us. And they don't want to do business with anyone else. I mean, literally, we're going to single source you. And if that's the case, it's the conversation with the customer is like, we need some help. I mean, this business is not profitable for us. And so, none of these are easy conversations. It's not easy for our sales guys. It's not easy for me when I'm involved. But, we do think there are improvements at pricing and product available that will begin to show up in the second half of this year, and will show up over time in the next year, in the 23 March year and going forward. And the other thing that's clearly happened is there's global tightness in display supply, and we have greater pricing power. And so that shows up really from kind of July pricing, which is going to be our Q2. We think we see significant upward repricing of what we're doing in the LCD space, and that will be an earnings driver. So those are the kind of the visible upside opportunities. The downside risk is a semiconductor shortage. We have priced in that quite a bit. We've taken in about 30 billion yen in revenues out of our this year forecast on the basis of we're not going to have enough semiconductors, so specifically driver ICs, to meet customer demand. I mean, it's a way of saying we have more customer demand than we think we may be able to supply. And the downside earnings risk is relative to our forecast is also upside. So in other words, we've priced in a lot of risk, as we should. I mean, this is a disruption of the global supply chain that has never happened. There is an absolute critical shortage of integrated circuits. And we are battling with that on a daily basis. We're optimizing the supply chain and moving things around for customers to avoid line shutdowns and working with suppliers and how do we get more product and optimizing the time in that product to link up to clients' own needs. So we priced in a bunch already in terms of downside earnings risk on this. If it gets worse than that, then we'll have a more earnings risk. If it gets better than that, then we'll do better than what we have in our forecast. On the margin, things are getting better, but more capacity is coming on. But it's still really terrible. I mean, it is unprecedented bad situation, and it's something that, as CEO of JDI, I'm personally involved in because I should be. It's a very important issue. I won't go through in detail. I'll happy to take Q&A, but across the board, we've got a lot of things we're doing that are important. It's OLED, it's sensors, it's automotive, industrial, healthcare, new businesses. I wanted to touch a little bit on the VR market. We have very high hopes for this market. VR is, we've got some data from our market information provider on the right hand of the page that speaks to display market growth, which is compounding based on their estimate of 27% over a multi-year period, which is great. I mean, we'll take 27% CAGR, but truth of the matter is there is yet to be a killer app in VR, and we so hope there is one. And the reason is we have a significant competitive advantage in the ultra-high resolution LCDs that have become fundamental to VR. The current market is primarily an 800 ppi market. We're clearly going to 1,000 ppi or above. We are totally capable of delivering against that. It appears to be the case that our competitors are having yield problems and technology problems in achieving these levels. So this is a good business for us. You'll notice that I didn't put into the upside earnings opportunity on the previous slide higher VR sales because we just pointed to OLED. We actually think the VR we've got in kind of baked in earnings growth that's coming out of OLED this year and a VR from the end of next year where there's kind of a product transition that occurs and we expect to have a significant earnings driver. And if there is something more than this VR display market growth that we have on the page, that will be very, very good for JDI. So we have some option value. And if any of you are programming killer apps for VR, we thank you. Let me talk about one other very important technology initiative. And this is the first time we've disclosed this. We fell behind in OLED, not from a technology perspective, but from a CapEx perspective. We continue to have, and this is kind of the strength of JDI's engineers and technology leaders. You know, we continue to beat the competition in our technology and at the level of mass production. So it's not that we create neat things in the lab, it's that we produce at volume the best product in the world from a functionality perspective, from a quality perspective. So we're shipping current generation OLED, existing generation OLED. And as I said earlier, we will expand it. What's on this page is we're working on an absolute revolution in the space. And the reason why this is important is, you know, so JDI fell behind in OLED. So what's the plan? And do you have a plan? And is it ambitious? And we have a plan. It's very ambitious. We've gotten to, we're in sampling of next generation ultra high brightness and ultra high resolution OLED. It is an overwhelmingly superior OLED technology. It will completely change not only the OLED space but the display space. You choose, you know, with displays either brightness or power consumption. So you can either have a much brighter display or you can have half the power consumption. This technology allows for that. It's also it is of course high definition. It uses the capabilities of OLED to be flexible. It has a totally unique product capability. You can actually integrate sensors into it, so which is a brand new deliverable for the technology. And what's not on the page is actually lower cost. So this will completely change the OLED and display ecosystem. We're not doing this by ourselves. We do have partners on this, as we should, in order to do something as big and revolutionary as this. I'm not going to go into details, but you know, we will continue to update you on how we're progressing this technology. And the reason we're talking about today for the first time ever is we've made a lot of progress. We're confident that we're going to be shipping this, and we look forward to a massive victory, the revenge of JDI in the OLED space. The final point is we're going into a number of new businesses. It actually is a case in Japan that you have articles of incorporation that describe what you're going to do as a business, and our current articles of incorporation only talk about displays. And we're going to do sensors and solutions and services and all sorts of things that are not currently part of our mandate as a company. So we announced today that we'll be changing our articles. We'll be amending our articles of incorporation subject to shareholder approval in June in order to do a whole bunch of new things. So those are Okochi-san's my prepared remarks. We're happy to take any and all Q&A, as JDI works on personal tech for a better world.
I'll close the conference.
That's right. Thank you, everybody, again. It's a tough world out there. Take care, be safe. We're really grateful for your time. Thanks for spending time with us today.